All right, welcome to the world of moving averages. There are two kinds, exponential and simple moving average. Exponential is just a very fast type of moving average where it creates a trend line that represents or sits close to the price action. There are pros and cons to that. The pro is that it's closer to what's happening. The con is that if something weird happens like this day, you're gonna get a skewed, a little bit more of a skewed trend as in terms of a line, right? So if we use that as an example, right, we'll do exponential. So this charting platform is called TradingView. You can sign up for TradingView. It's free, tradingview.com. So typically we're just using the EMA 9, so 9 EMA. You can see that it's already turned lower, and you may make a mistake to short or sell when the overall um, when the overall trend is still higher, right? Whereas if you use a simple moving average, it's a slower type of averaging algorithm. Now, I'm not gonna go into great detail because I have to make sure when I'm explaining these things, I have to take into consideration those of you who may not have a mathematical background and who do not need something super lengthy and complicated, right? So I'm really making this as simple as possible, and it is in no way trying to insult some of you who are who are very competent when it comes to trading. So the other line there is the 9 simple moving average, and I'll change it to orange, and you can see that they're similar but not quite. So this is a perfect example here. Do you see, right? The blue line here points lower, right? So this is the 9 exponential moving average, as you can see on the upper left. So it turns lower, it tells you, hey, I think the trend is changing, we're going to go down. Whereas the orange line, the 9 simple moving average, is telling you, yeah, we kind of took a pause there, but hey, we're still intact, right? Tells you again that the trend is still higher, and remember, the trend is your friend. So you can see the difference there, right? That you would want to use. In my own personal experience, like when I really want to use something, I always stay with the simple moving averages. I don't use the exponential because, again, for that exact reason where they might give you the false turning point or the false trend change, and you might, you might be forced to trade a different way, and then you'll end up losing money. But the biggest crux or weakness of the moving average is that this takes so long to form. Like it needs a lot of data to create a trend. Okay? That there is the weakness of the moving average. There are several popular moving averages, so the ones that Wall Street or most people use, okay? The 50-day, and then you got the 200-day moving average. So you can go in increments of 50 too, by the way. So you can put 200, you can put the 100, the 200, and all that. But Wall Street and major trading firms use only the 50 and the 200, and it gives you an idea of where they are, right? So it gives you an idea. For example, how do you interpret this, right? When you're looking at this from a daily chart, you're thinking, okay, the trend is still higher. You know, it is what it is. But again, remember what I said, it's lagging. So if there is a turning point here and we start to really do reverse and go down, this will not tell you that it is happening, right? Here is an example where during the COVID-19 crisis, it's turning down. This is still telling you it's still going to go higher until most likely around here when it starts to turn lower and you're like, okay, something's going on. But you would have missed this opportunity to short, right? Because the moving average is too slow. So this is one thing you need to be very aware of when you are trading. This is not, I want to repeat, this is not an indicator to tell you when it has bottomed or topped. This is an indicator that tells you where the strength is. The problem is it does not tell you how strong the trend is, right? So always be aware of that. So that in itself is what they use. Now, if you're going to use this again, this is why it's important for you to know that it's just telling you the trend of where things are. Instead of using the Nasdaq, let's go find one of the more interesting pairs of forex, right? So this is the dollar yen. So it's telling you right now, okay? If we remove everything else, the 200 is telling you, okay, I think we're kind of going lower. The 50 is telling you, okay, we might be going lower, right? So it's not very extremely clear. And here's the other weakness too, which is probably the most dangerous for moving averages. In a sideways market, when the market doesn't really go high or low, it's just kind of, oscillating around a certain range. This becomes flat, right? Because because again, a simple math to check that. If you have +1 and -1, when you take an average of those, what do you get? Zero, right? So that is exactly what's happening there. Okay, so that's the weakness of the moving average. But if you must learn how to use it, this is how you want to use it. All right, so what have you learned? Exponential moving average hugs too close to the chart. It might give you, the wrong signals when things turn. Simple moving average, not as you know, tightly connected to the chart, can give you enough time to decide where the trend is and can give you a better view of where things could go. But all in all though, they're all still lagging and you have to be aware of that when you're using them. You'll have to experiment what number works for you, right? What is because there isn't like one rule where you got to use a 20 moving average or the 25 moving average. It's all up to you in terms of what you would like to see on the charts. You'll most likely see so many people say use the 50, use the 200, but ultimately what it means these numbers is that so that you understand these numbers just mean it needs 50 candles or 50 prints to make a good assumption as to where things go. So you can already see that the bigger the number, the longer you can finally get a trend, right? So the trend definitely is good. The current indicator is really good, but the problem is again, for something like here, for example, if you took a short here, it kind of stayed here for a while before coming down. And that can definitely give you a lot of anxiety, unwanted anxiety too. Okay, so moving average pros gives you a trend. The con takes forever to form something, and it can be useless when the markets are sideways. And picking the right averaging number, like the 50 or whatever, can take a little bit of experimentation until you find one that works for you that you're comfortable with in giving it a trend.